Thank you, Julia. And thanks everyone for being here, and great weather for getting everyone indoors and listening to us. So thanks for being here. And the topic for today is navigating risk, and we'll be focusing on purchasing, sale, and financing of art. And we have two eminent attorneys here in New York who deal with these matters all the time. And I'll be asking them the tough questions. So hopefully you'll get some really compelling insights to take away. And it'll be a very fruitful session for you. And before we get into it, and we talk about purchasing, sale, and financing, and the financing, or at Deloitte as we refer to it, art secure lending. So using your art as collateral to access equity. In other words, get a loan. And this is a more recent phenomenon, more than, per se, buying and selling of art. And we see a real trend recently in the industry, and now there's around, we think, around $20 billion of art loans outstanding. And there's three real cohorts or segments of lenders that are driving this. So it's your traditional private banks. And those private banks typically were lending as a way to differentiate their services and to get clients. But now it's really become something that they need to do as a necessity. And they'll typically loan in the lower single-digit interest rate range, and that's because they have the client already, and they loan more against the credit because they hold and manage that client's assets. And we see another group, which is the auction houses, Sotheby's in particular, which has around a $1 billion credit line, and they'll typically loan in the higher single digits, and they did it traditionally to attract consignments, but now it's really become a cash cow for them. And the third cohort is what we call boutiques or asset-based lenders, and they're really smaller firms who are really starting to flourish in the market. And they loan purely on the asset itself.